why your small trading account isn't making much money and how to fix it. This is you. You've been trading for a while and yet you're not making much money. Even if you're technically profitable, the small size of your account means your gains feel trivial. Sounds familiar? In the next few minutes, I'll explain why this happened and how can you turn these things around. Hello, my name is Peter and I'm part of the HyroTrader, a crypto prop firm that funds profitable traders. We are currently having 30,000 traders and have paid out more than 2 million in profit. That being said, let's get into it. In the trading world, fundamentals beat flash. If you're the underdog with a small account, you need to heavily rely on sound strategy, not the hype. For example, if you manage your trades with a 2-to-1 reward-risk ratio and win around 40 to 50% of the time, you should be profitable. This is simple math and it's an underrated fundamental that many traders overlook. Why? Because the trading culture, especially in crypto, is obsessed with quick wins, moon boys and hypes. Everyone wants the next moonshot, the flashy 10x overnight. Meanwhile, the consistent, methodical traders remain hidden in the shadows, rarely tweeting their modest 1% gains. But let's just cut through the noise. Slow and steady trading isn't sexy, but slow and steady works. Mastering basics like risk and reward and win rate is far more important than chasing hot tips. In fact, focusing on these fundamentals is the first step in breaking out of the small account trap. A tale of two traders, Alex versus Brian. So let me illustrate with a quick story of two traders who took very different paths. Trader A, let's call him Alex. Alex is a very patient trader. He's been trading for a long time and focuses on a long-term steady profits. His strategy shoots for roughly 1% account growth per winning trade. Nothing dramatic. But here's the magic. Every time Alex wins 1%, his account grows and that gains compound over time. And this is what he says. 1% at a time, that's what I climb. Even with these occasional losses, his disciplined approach means that he's gradually grinding his account upwards. Now, for the contrast, the trader B, we call him Brian. On the other hand, Brian is all about the big wins, right? Early on, Trader B or Brian caught a few lucky trades and made a lot of money quickly. Flushed with confidence, he started risking more and more on each trade. Essentially, Brian began flipping a coin with his account. If it lands heads, he doubles his money, and if it's tails, he loses the whole account. At first, it seemed like he couldn't lose, until the odds caught up with him. One bad trade wiped out a huge chunk of his account and then another, and suddenly Brian's fortune is reversed. Because he kept increasing the risk after each win, the eventual loss hit hard. And this is the coin flip effect. It's literally working against him. With a string of risky bets, it was only a matter of time before luck ran out. Basically the strategy of way he cannot even win on the long term. So what's the lesson here? Alex, slow and steady approach might not make headlines, but it's sustainable. Brian's approach led to a classic boom and bust cycle. As the saying goes, slow and steady wins the race. In trading, fast and reckless can put you out of the race entirely. To summarize Alex's secret in one sentence, the more money I make slowly with small wins, the more I compound. But if I take a huge loss, I set myself back significantly. In contrast, Brian's experience shows that big gains can lead to overconfidence, which leads to taking bigger risks, which eventually leads to big losses. Well, worst case scenario, Brian blows up his account completely. And that's something we want you to avoid at all costs. So failure, the best teacher, if you listen. Here's the hard truth. Most traders fail at first. We all do. Trader A, aka Alex, probably wasn't always the disciplined master trader. He, likely had his moments like Brian. The difference is that after each failure, he learned, adjusted, failed less the next time. And that's how consistent traders are born. Not from avoiding failure, but from, learning to fail better. Many beginners crash, burn, blow accounts, and quit. A few persist. They have to swallow their pride, figure out what went wrong, and develop their own edge over time. And this each failure carves away bad habits and leaves behind some lessons. And eventually those traders start failing less often and less dramatically. They find so-called consistency. The ultimate mindset shift here is letting go of the belief that one big win will change everything. You have to accept that trading is hard and success comes only after surviving mistakes and honing your risk management to a razor's edge. Now let's zoom in on what happens emotionally when a trader like Brian takes high risks. It's really a vicious cycle many have experienced. Number 1, euphoria. Our trader risks big and hits a huge win. Maybe he's using a high leverage on a trade or doubles his account in a week. He's ecstatic. Look at that bright big smile. Confidence is through the roof. Maybe even some cockiness is coming in. So if 10x leverage made me $5,000, why not try 20x and make 10,000, right? Makes perfect sense. Until it does not. The number 2, anxiety. Our trader encounters an unexpected loss. Perhaps one trade wipes out a large portion of those gains. The big smile fades, anxiety kicks in, and he's thinking, I've gotta win it back. The pain of giving back profits or going into the red makes him restless. Instead of stepping back and rethinking the whole deal, he immediately plots a revenge trade to recover the loss. Not good either. Number 3, desperation. When he's caught in this emotional spiral, he risks even more on the next trades, hoping to quickly erase the setback. Now he's trading on a tilt, on an emotional tilt and not logical. A second loss comes, then maybe another one. Each hit feels like a punch to the gut. Suddenly he's in a deep hole wondering, what have I done? At this point, the fear and despair dominate, and this often leads to even more mistakes or complete paralysis. It's a bad place to be in. This downward spiral is common, but it's also a fallacy. Just because many traders fall into this trap doesn't mean you have to. These emotional swings are not mandatory rite of passage, meaning you don't have to do this. They result from poor risk management and lack of discipline. And you can break the cycle with the right approach. How do you avoid a boom-bust emotional roller coaster? Risk management. The boring, unsexy, absolute foundation of trading success. Master this and you'll never be Brian spiraling out again. Here are some fundamental risk management rules to live by. First one, risk only 1 to 2% per trade. Limit your risk on any single trade to a small fraction of your account, typically no more than 2%. This way, no single loss can hurt you too badly. Even a string of losses will knock you out. It's mathematically very hard to blow up if you stick to 1% risk each time. Set a daily loss limit. For example, decide that if you're down 3% in a day, you stop trading for the day. Simple as that. This personal rule should be even stricter than any firm's rule. Prop firms like ours might have a 5% daily drawdown limit, but you should give yourself a little buffer at 3. This prevents one bad day from snowballing into the loss of your account, and we don't want that to happen. Understand drawdown math. Remember that the deeper the loss, the harder the recovery. If you lose 10% of your account, you need an 11% gain just to be break even. Lose 20% and you need 25% gain to recover. God forbid you to lose 50%, you'll need 100% gain. So initially double your money to get to square one. Well, you got to protect your downside at all costs, because climbing out of the hole is much harder than avoiding one in the first place. Stick to your stop losses. Stop losses, stop losses, stop losses. Everybody preaches about them, but do we do them? Well, always you gotta know exactly where your stop loss is before you enter a trade. If the trade goes bad, accept the small 1% hit and get out. Don't widen your stop. Don't hope it comes back. A small loss is a win compared to a catastrophic loss or a blown account. These principles might sound basic, but ask yourself, do I consistently follow them? Because successful traders, they do. And they do religiously. Well, as a trader Paul Tudor Jones famously put it, don't focus on making money. Focus on protecting what you already have. In other words, capital preservation is profit in this game. So if you blow up your account, you're done. Zero. But if you preserve your account, you live to trade another day and another with infinite opportunities to hit new profits. Now I'm going to give you a bit of homework, because you just reading about risk management isn't enough. You need to practice it until it's a second nature. Here's what I suggest. Simulation exercise. Open a demo trading account or use a small amount of money you can afford to lose and commit to a risk limit of 1% per trade for the next 20 trades. No exceptions, you gotta log each trade. Well, you gotta stick to the plan, right? Journal your emotions. Keep a journal beside you. Every time you feel the urge to double down or skip a stop loss, write down what you're feeling and why. This will help you recognize emotional triggers. For example, do you get impulsive after 2 wins in a row, or do you lose after 3 p.m.? Write it out. Which trading session is the best for you? Next one, review and reflect. After those 20 trades, review your performance and notes. Did the 1% rule save you from bigger trouble? How hard was it to stick to it? Where did you slip? These reflections is really gold. It shows you where your discipline cracks and where to reinforce it. I know, we said it many times, but these practical exercises are crucial. Reading or watching videos about risk control gives you knowledge, but only practice will turn into a skill. Just like you can't get fit by reading about push-ups, you cannot master risk by nodding along this video. You have to implement it on the charts or do your push-ups. Small accounts aren't worth trading. The gains feel so tiny. That's what people often complain. True, making 1% on the $1,000 account is just $10, not exactly a Lamborghini money. But here's the analogy. Would you rather learn to sail using a small boat or a Titanic? Sure, a Titanic-sized ship can carry more treasure, but it's also harder to steer, slower to adjust the course, and when the disaster strikes, it sinks dramatically. A small boat, on the other hand, is nimble. You can change direction, you can learn how to steer it, and there are far fewer consequences if you hit a rock or bruise your ego per se. But you won't drown, right? That's the ultimate thing. The only downside of a small boat is that it's not as exciting. For your brain's reward center, the dollar amounts and numbers, they don't release the same amount of dopamine as a big win or on a big account. But the goal right now isn't to get rich quick, it's to master the craft. Think of your small account as a training ground. It's much easier to develop a strong risk management habits with 1K than with 100K. By the time you will have access to larger capital, whether through savings or funded account program, you'll be prepared and disciplined. Now, here's another game changer. Consistency in your approach. Many traders with small accounts make the mistake of constantly switching strategies. 1 week you're scalping, the next you're doing Elliott wave analysis, then chasing the latest indicator someone hyped on Twitter. That's like a company that keeps pivoting to every new trend versus one that sticks to a proven business model. Imagine company A and company B both start in the same industry. So company A picks a solid strategy and continuously refines it. They know their product and market, and they get better at execution over time. Company B, on the other hand, changes its business model every month, looking for bigger, quicker payoffs. After a year, what do you think? Which company is likely doing better? Well, probably company A, which stayed consistent and honed its edge, while company B kept resetting its learning curve. The same goes for trading. Trader A uses one core strategy, set up, and trades it. Over and over and over, he grinds it to the limits. He logs every trade, learns the nuances, and improves his execution and confidence in the setup over time. However, Trader B is a strategy nomad. He tries something for a dozen trades, hits a rough patch, then jumps to a new strategy. He never sticks with anything long enough to truly master it or to understand whether it actually works in the long run. Over time, Trader's A equity curve is just beautiful, exponential. Likely far more stable and upward, whereas Trader's B, the results are all over the place. It's better to be consistently okay than occasionally brilliant. Let me repeat that. It's better to be consistently okay than occasionally brilliant, and even frequently terrible. In trading, consistency is the key to scaling up safely. As one trading mentor said, 2 traders can use the same strategy, but their results will never be the same. Mentality and risk management makes all the difference. In other words, the strategy itself matters less than your ability to execute it consistently with a good risk control. So pick a plan and stick to it. Let's see what happens. Give yourself the chance to actually get good at it. Paul Tudor Jones, billionaire trader, famously said, "The most important rule of trading is to play great defense, not great offense." He focuses on risk control and capital preservation above all. What he initially says is to protect your account first, worry about profit second. Keep that in mind. Warren Buffett. We all know our OG, Coca-Cola, McDonald's. He's rather investor, but these rules apply to trader as well. You could probably tattoo it somewhere on your forehead. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Of course, losses are part of trading, but the idea is to avoid the big losses. The one that put you in a misery and they are harder to get back on track. Each of these quotes underlines a common theme: survival and consistency over ego and excitement. Well, keep this in mind when you feel the temptation to do something reckless. Here is a straightforward action plan to put all this advice into practice. Well, master your strategy in demo if needed. Pick one trading strategy that suits your style and master it. Practice on demo account or very small account. Focus on execution quality and consistency rather than making money. Prove to yourself that you can follow your own rules over, let's say, 50 trades without any deviation. Next one, remove ego. Be a student, Check your ego at the door. Approach trading like a perpetual student. Every trade, win or lose, it's a feedback. It's not a reflection of your worth. If you catch yourself thinking like, I'm so good, I'm the guy, or I'm awful after a loss, take a pause, take a break. Remember, it's just one trade. It's a part of the process. The next thing, journal every trade. Start trading journal if you haven't. Record why you took each trade, how you felt, the outcome, what you have learned. This will become your personal roadmap to improvement. You'll spot patterns in your behavior, both good and bad, and these patterns you wouldn't notice otherwise. It's a great tool to boost your wins. Well, ultimately, do the work. This is not so glamorous part. Analyze your trades regularly, study charts, be present, read quality trading books or courses on risk management and psychology. Backtest your strategy. Treat trading like the profession it is. It's your own personal business. This also means that you have to prioritize and work proportionately towards it. Many traders, they want to make a doctor or lawyer money, but they are not really trying to provide any reflective amount of work towards it. Build a routine and stick to it. Consistency in routine leads to consistency in performance. Set trading hours, pre-market preparation, post-market review. By following these steps, you're effectively doing the same level of work for your trading as you expect to do it in any high-level career. And this is what most people miss. They want the money without the effort. So don't be most people. At HyroTrader, we are all about empowering the underdogs. We provide funded crypto trading accounts, meaning you can trade up to 200,000 in capital without risking your own money. And then you can prove yourself in our challenge. We funded hundreds of traders and seen them go from grinding tiny accounts to manage serious risk capital. The difference is the risk management and consistency. Exactly the whole thing we've been talking about. If you think you're ready to take your trading to the next level, check out our platform. Thank you for watching, and remember, slow and steady, it wins the race.